Hi, I'm Jim Leaviss from M&G Investments. It's not often that a blog gets a lot of attention in bond markets, but this one did. It was on the Bank Underground blog from the Bank of England called Venetians, Volcker and Value-at-Risk, 8 Centuries of Bond Market Reversals. It was by Paul Schmelzing, who is visiting the Bank of England from Harvard University, and he is with us here today to talk about the blog. Hi, Paul.
Thanks for having me.
Now, the first thing you do in the blog is really think about the last 800 years of bond markets and the risk-free rate, and ask the question, we've been in 30 years approximately since Paul Volcker started trying to kill inflation, of bond markets being in a bull phase globally. How does this 30 years of yields falling around the world compare historically? Is this a big move? Is it one of the bigger moves, or how does it fit in?
Well, I'm not the first one to realize that we live in extraordinary bond market times these days. I mean, when more than 10 trillion of fixed income assets yielded negative in the middle of last year, when central banks around the world embarked on unconventional policies never seen before, people started wondering, have we been here before in really the long secular space? And so I tried to track the risk-free rate back as far as we have data and as we can look at. And it turns out you have to go back really far to find a couple of similar cycles in the bond market space. We have data until the 12th and 13th century, when the Italian city-states started to circulate their forced loans among secondary markets. And it turns out, both in terms of length and in terms of yield compression from peak to trough, there are only really two markets that can compare. One is in the 1440s, when the Venetians were at the height of commercial dominance in the Mediterranean Sea, when they defeated the Ottomans and when they were firmly in control of the very lucrative trade routes. The other one is after the so-called Peace of Cateau-Cambrésis, when the Spanish gained control of the richest city-states again in northern Italy from the French, and pushed them out of the great power game for a couple of years. And it turns out that those 36 years since Paul Volcker declared a war on inflation after the oil shocks are really in that league among the 2 and 3 biggest and longest bull markets for bonds ever recorded.
So all good things come to an end, and eventually this bond bull market will. You've looked at different instances again through history. What are the common ways in which bond markets take fright and go into reversal? I think you talked about 3 separate ways. The first one was about inflation.
Yeah. I mean, there are various stylized ways, of course, to group the various bond market reversals. Note that in the centuries before the 19th and 18th century, it was usually geopolitical events that turned around the bond markets. The dynamics change once we get central banks in the US markets in the 20th century. And so I thought it would be interesting to zoom into 3 bond market reversals that caused a lot of volatility in the 20th century, that caught a lot of investors by surprise in the days. And the first episode, which I call the inflation reversal, is really in the second half of the 1960s. We came actually from a similar environment as today. We came against the backdrop of a very tight US labor market, rather muted fiscal expansion. We get new elections in the US. We get a bit of geopolitical turmoil with the Vietnam War. And so Lyndon Johnson decides to stimulate the economy a bit with a fiscal mix, and that sends CPI inflation in the US spiraling. Really, it almost quadruples within 4 years. The Fed is slow to hike rates in response, so it's behind the curve. Critics would accuse the Fed today to be behind the curve as well. And that kind of scenario turns out to be really bad for bond investors in the end. I mean, in cumulative terms, bond investors lost 36% in real price terms in 4 years between 1967 and 71. And it was one of the worst episodes for bond investors in the 20th century.
I guess the next one we'd look at, potentially the Fed was ahead of the curve. It was the 1994 bond shock, where the Fed unexpectedly, I think, really hiked interest rates, and we saw a big reversal in bonds. But in your paper, you argue that there probably were some early warning signals that ahead of that bond sell-off.
That's true. I mean, the 1990s are remarkable because you have several new technological trends. You have electronic trading in the bond markets that start to really influence the volatility and the turnover in bond markets. And you have a remarkable amount of leverage in the system as well. You have a lot of institutional players. You have hedge funds that often speculate with 1 or 2 cents on the dollar on certain bond market trends in the early 1990s. Now, in various regions in the world in the early 1990s, we have a lot of fixed income turbulence, i.e. the ERM crisis in Europe. We have the emerging tequila crisis in Mexico. We have turmoil in places like Venezuela, Turkey. And even before the Federal Reserve hikes rates in February 1994, with the Fed funds, we get a lot of volatility in those kind of places. And for diversified funds, they also already incur losses ahead of February 1994. And so they have to liquidate positions, and US bond market volatility already rises in the third quarter of 1993. And so the so-called bond massacre of 1994 really starts before the Fed signals it is hiking rates. And I would argue it's not the Federal Reserve by its response worsens the crisis, but it doesn't directly trigger it in the first place, I would say. It's a combination of really exogenous factors as well on the US bond market that causes a lot of these losses, and a lot of hedge funds get the direction wrong, they get burned. 1.5 trillion of global bond market values are wiped out within 1 year. But it's a very steep and sudden drop that returns to a bullish sentiment rather quickly as well. By 1995, we're back again at decent returns. For 1995, people actually gain 18% in the year in real price terms. That's an example of a sharp but sudden reversal in the market.
And the final one you talk about in the blog is a Japan-specific example, a value-at-risk shock. Can you explain what that is?
So a lot of banks have internal models that calibrate the kind of exposure in terms of volatility, in terms of daily maximum losses that you can incur on certain books and positions. Once you breach those thresholds that various institutions set for themselves for regulatory purposes, for own internal purposes, you have to liquidate positions. And Japan is interesting because, remember, Japan was the first developed major economy that tried the infamous quantitative easing policies in 2001. By 2003, inflation dynamics seemed to pick up. The rumors start circulating that the BOJ might taper in response. And ahead of the middle of 2003, similar to what we've seen after January 2016 when the BOJ went negative, the curves flattened dramatically in Japan. Now, when those rumors circulate, we also have the Iraq war, which causes geopolitical instability. Suddenly the JGB curves massively steepen again. We have a major reversal. And that is triggered by the increasing volatility of JGBs in the end, and a lot of banks had to shed their positions. And since every bank basically had the same kind of thresholds, the same kind of internal models, it was a kind of herd behavior that suddenly caused a massive dumping of JGBs in the market and a massive turmoil for investors.
So thinking about those three models of historical bond bear markets, if you had to think about what might bring about the end of this 30-year bull market, which of those, or perhaps a different one, seems most likely?
So I think what might be a little bit of concern for investors is that we are seeing elements of all three reversal in the current markets to varying degrees. But I think I talk about, a really pessimistic reader could identify ingredients for a perfect storm. We have picking up inflation dynamics clearly from China, where PPI is now 5.5%, to Germany, to the US, where wage growth is really picking up. So that element is definitely there. And I think to some extent, if people look at the 1960s, they should be aware that those inflationary dynamics can catch people by surprise, especially when we have a fiscal stimulus on top of, a tight labor market. So that is one of the drivers that I think is quite present nowadays. The other one is, as I mentioned, we had a dramatic flattening of bond curves until the middle of 2016. That trend only has partially reversed until now. And so I think we still have a way to go to normalize the shape of the curve as well. That is painful for a lot of people who are not in the maturity transformation business. As good as it might be for those who borrow short and lend long, it causes a lot of pain for other people. So we should be aware of that trend as well. It's not over, the normalization of the shape of the curve. And the other thing is we have, of course, also the elements in emerging market nowadays when you look at China, which has an unprecedented debt dynamic, that emerging markets where US investors, where European investors that went for a hunt for yield around the world, often with leverage as well, could get burned if the Fed surprises people by hiking faster than people might anticipate, and those kind of exogenous factors could impact the risk-free rate as well.
Great. Thank you very much, Paul Schmelzing. Very recommend reading the Bank Underground blog. It's great. Thanks, Paul.
Sure.